Here is something that most people, including most highly educated people, get completely wrong. Banks do not lend out money that depositors put in. They never did. The money that a bank loans to you is not taken from someone else's savings account. It is created from nothing at the moment the loan is issued, and it did not exist before you signed the paperwork. This is not a theory. It is not a conspiracy. In 2014, the Bank of England published an official paper titled Money Creation in the Modern Economy that states this plainly. Whenever a bank makes a loan, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. If you were never taught this, you are not alone. Most economics curricula still teach an outdated model, and the gap between how people think money works and how it actually works has enormous consequences for how they navigate their financial lives. How it actually works. When you walk into a bank and take out a $10,000 loan, the bank does not go to a vault, count out $10,000, and hand it to you. It opens a computer screen and types $10,000 into your account. That money did not come from existing deposits. It came from the bank's ability to create a liability, your debt, and simultaneously credit you with an asset, your new balance. The money supply of an entire economy is primarily created through this process, not by governments printing physical currency, not by central banks alone, by commercial banks issuing loans. When you repay that loan, the money is destroyed. The $10,000 you borrowed into existence disappears as you pay it back, principal by principal. The interest is the bank's profit on money it created at no cost to itself other than regulatory compliance. Fractional reserve and its limits. The traditional explanation of banking, that banks hold a fraction of deposits in reserve and lend out the rest, is called fractional reserve banking. In its simplified form, it suggests that if 10 people each deposit $1,000, the bank keeps $100 each in reserve and lends out $900, which then gets deposited elsewhere, lent again, and so on. The reality is that reserve requirements do not actually constrain lending in the way this model implies. In the United States, the Federal Reserve reduced reserve requirements to zero in March 2020, and lending continued. In most developed economies, what constrains bank lending is not deposit levels, but capital requirements, the demand for loans, and the bank's own risk assessments. Banks do not need deposits to make loans. They need capital buffers, regulatory approval, and a willing borrower. The debt-based monetary system. This brings us to a fact that almost nobody sits with long enough to fully absorb. Virtually every dollar, pound, or euro in the modern economy was created as a debt. Every unit of money in circulation exists because someone, somewhere, borrowed it into existence. When that debt is repaid, the money vanishes. For the money supply to grow, which growing economies require, the total level of debt must grow. A world with no debt would, under this system, have no money. This is not an accident or a flaw. It is the design of a system in which banks profit from every unit of currency that exists. The interest charged on created money flows to the financial sector. The obligation to repay falls on borrowers, governments, businesses, and individuals. When governments run deficits, they issue bonds, essentially taking on debt, which the banking system purchases and monetizes. When central banks conduct quantitative easing, they create new digital money to purchase those bonds. The money supply expands. The financial system's balance sheet expands. The purchasing power of existing money contracts. Why this matters to you? Understanding this does not make the system illegal or immediately escapable, but it changes the framework for every financial decision you make. If money is debt-backed and the supply is controlled by institutions whose interest is in perpetuating borrowing, then carrying consumer debt is not merely inconvenient. It is participation in a system designed to extract value from people who don't understand it. The people who profit most from this system are those who sit on the other side of it, as lenders, equity holders, and asset owners, rather than as perpetual borrowers. Like and subscribe for more breakdowns of financial systems that shape your life, whether you understand them or not. Drop a comment. Did you know this before today? Thanks for watching.